Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by 𝗩𝗹𝘂𝘁𝗲𝗄. How not to get fooled by stock prices. In volatile markets, the obsession with price movements can lead investors astray. The Indian stock markets have been a roller coaster lately, creating a peculiar spectacle. Every morning, news channels and social media feeds fill up with breathless commentary about stock prices and index levels. The constant volatility has turned many investors into anxious price watchers. They check their phones every few minutes to see if the latest price movement holds profound insight into their investment decisions. This obsession with price movements reveals a fundamental misunderstanding about what stock prices mean and how they should influence investment decisions. The problem isn't just the unhealthy fixation on short-term fluctuations. It's the flawed mental model many investors have about stock prices. I observe so many investors who believe that a stock with a low price is somehow cheaper and therefore a better buy than one with a high price. This misconception has fascinating parallels with how investors view mutual fund NAVs, where many think funds with similar NAVs must be comparable investments. Both beliefs are equally misguided. The mutual fund industry has long battled this misconception, where investors mistakenly believe that a fund with an NAV of 15 rupees is somehow cheaper or has more room to grow than one with an NAV of 50 rupees. Fund managers and advisors must constantly explain that NAV is merely an accounting measure, not a measure of value or future potential. Yet, remarkably, even sophisticated investors who understand this concept for mutual funds often fall into the same trap with stock prices. Let's think about the concept carefully. Yes, the price of a stock legitimately plays a central role in investing. A low price is a valid reason for buying, and a high price can be a good reason for selling or avoiding a stock. This concept is fundamental to almost all equity investing. However, this high or low is not an absolute level floating in a vacuum. It's high or low compared to what you have independently concluded is a reasonable price for that particular stock based on its fundamentals, prospects, or other relevant factors. The current market volatility makes this confusion worse. When prices swing wildly, investors often lose sight of this crucial distinction. A stock trading at 15 rupees is not inherently cheaper than one at 500 rupees. The 15 rupee stock could be grossly overvalued at that price, while the 500 rupee one might be a bargain. The raw price numbers simply aren't comparable between different companies. Curiously, this flawed thinking has spawned an entire investing subculture focusing on cheap stocks, rupee stocks in India and penny stocks elsewhere. The allure of low-priced stocks is so strong that even specialized research tools and websites are dedicated to filtering for them. It's as if the absolute price level has become a criteria for investment decisions independent of any fundamental analysis. The irony is that sophisticated investors use price-based ratios like price to earnings or price to book value as analytical tools. These ratios are comparable across companies because they contextualize price against fundamental business metrics. However, extending this comparative logic to raw price numbers is a basic mistake many investors make, especially during volatile periods. In today's environment of heightened volatility, this price fixation becomes particularly dangerous. The constant price movements create an illusion of information where none exists. A stock dropping 5% in a volatile market doesn't necessarily mean it's become a better buy, just as a 5% rise doesn't automatically make it overvalued. The solution is not to ignore prices entirely. They are crucial for investment decisions. Rather, it's important to understand that prices only make sense in context, whether the company's fundamentals, prospects, or broader market conditions. In volatile markets, this perspective becomes useful and essential for maintaining investment sanity.